With interest rates in developed markets close to zero and likely to remain there for the foreseeable future, investors are seeking opportunities which provide two things: strong yields and capital protection. In the current environment, corporate bonds offer both these attributes. Investors can earn attractive yields with security by investing in a diversified portfolio of relatively short-dated corporate bonds. Corporate bonds are a way companies raise money from investors for a fixed term to finance their business activities. Bonds are issued and repaid in a number of currencies depending on the term of the bond. The company issuing the bonds, called the issuer, makes regular interest payments, called the coupon, to the investor and repays the principal, that is the amount borrowed, at maturity. Both the coupon and the maturity date are set at the time of issue, so the investor knows exactly how much they're getting back and when. Let's take an example. Suppose a company issues a bond on 1 January 2012 with a 5-year duration and a coupon of 8%. This means that the company is borrowing money at 8% for 5 years. The company pays the lender, the bond investor in our case, an 8% per annum cash coupon and repays the capital borrowed on 31 December 2016. The coupon, or cost of borrowing, depends on the company. More established companies generally pay lower coupons, reflecting lower risk. Provided the bond is held to maturity, the investor is not affected by price fluctuations. Remember, the company has an obligation to repay the amount borrowed in full at maturity. This provides certainty to the investor. Because the coupon is set at issue, if the bond price falls, the running yield, which is the coupon divided by the price, increases. The running yield and capital gain together make up what is known as the yield to maturity or redemption yield. In other words, the total return that the investor earns from the bond to maturity. There are a number of advantages to the investor. Firstly, the investor earns an attractive yield. Corporate bonds provide a higher interest rate than term deposits or other cash-based products. Secondly, unlike equities, corporate bonds provide a consistent, predictable cash flow. The investor knows what cash he'll be receiving and when. Thirdly, the investment provides security, as corporate bonds rank higher in the capital structure than equities. Fourthly, corporate bonds are marketable. If the investor needs to sell a bond before maturity, in most instances this can be done relatively easily and quickly because of the size and liquidity of the bond market. Fifthly, because corporate bonds have a defined term, the investor has certainty as to when the capital will be repaid. Finally, there is the opportunity for diversification. Different companies in a range of industries issue corporate bonds. This enables a portfolio to be structured to meet an investor's particular investment objectives. Ashton constructs bond portfolios for investors based on their specific requirements. Portfolios can be structured in US dollars, euro or sterling and can be tailored to match the client's specific risk profile, ranging from the conservative through to the more aggressive. Clients have access to their portfolios via state-of-the-art secure, real-time online performance reporting.